Some Airbnb hosts are pulling in 3 to 5 times more revenue per month than their long-term landlord neighbors from the exact same type of property. Same square footage. Same neighborhood. Same mortgage. But wildly different bank accounts. That number stopped a lot of investors in their tracks when it first surfaced, and it should stop you too. In the next 10 minutes, you are going to discover exactly how both rental strategies actually perform when you put them side by side with real numbers, why the higher earning option is not always the smarter choice depending on your situation, and the one factor that most real estate influencers completely ignore when they make their comparison videos. By the end of this, you will have a clear framework to decide which path actually fits your goals, your market, and your risk tolerance. So let us start at the beginning and understand how we got here. The concept of renting property for income has existed for centuries. But the short-term rental market as we know it today was fundamentally transformed around 2008 when Airbnb launched. Before that, vacation rentals existed through platforms like Vrbo, but they were largely limited to tourist destinations and beach towns. When Airbnb opened the floodgates, suddenly any homeowner in any city could monetize a spare room or an entire property by the night. Within a decade, the short-term rental market exploded into a multi-hundred-billion-dollar global industry. Long-term rentals, on the other hand, have always been the traditional backbone of residential real estate investing, steady, predictable, and far less glamorous. The tension between these two models has only grown sharper as more investors try to figure out which one actually builds wealth faster. Now let us get into the real numbers, because this is where things get interesting. A typical long-term rental in a mid-sized American city might rent for somewhere between $1,400 and $2,200 per month depending on the market. The landlord signs a lease, collects rent, and theoretically has guaranteed income for 12 months at a time. The vacancy rate for long-term rentals nationally hovers around 6 to 7% on average, meaning most landlords see their property sit empty for less than a month per year. The expenses are relatively predictable. You pay the mortgage, insurance, property taxes, and maintenance. A common rule of thumb is that operating expenses eat up roughly 40 to 50% of your gross rental income. What remains is your net operating income, and that is what actually goes in your pocket. Short-term rentals tell a completely different story. A property that rents for $1,800 per month on a long-term lease might generate anywhere from $3,000 to $5,000 per month on Airbnb in a decent market. Some high-demand vacation markets see even more dramatic returns. But, and this is a massive but, your expenses are also dramatically higher. You are paying for cleaning fees, platform fees that typically run between 15 and 20% of revenue, furnishing costs, higher utility bills, supplies like toiletries and linens, and significantly more active management time. When you account for all of that, the net income gap between short-term and long-term narrows considerably. In many cases, a well-run short-term rental might net 30 to 40% more than its long-term counterpart after expenses. In some markets, that gap disappears entirely. But here is what nobody talks about: the occupancy rate risk that can turn your short-term rental dream into a cash flow nightmare. Long-term rentals maintain relatively stable occupancy because people need housing year-round. Short-term rentals are extremely sensitive to seasonality, local events, economic downturns, and market saturation. During the COVID-19 pandemic in 2020, short-term rental occupancy rates collapsed in many urban markets, dropping below 20%. Long-term landlords kept collecting rent, often with government-backed protections that kept tenants in place. Short-term rental hosts had their income evaporate almost overnight. That kind of volatility matters enormously when you are carrying a mortgage. There is also the regulatory dimension, which is becoming one of the most important factors in this debate. Cities across the United States and around the world have been aggressively cracking down on short-term rentals over the last several years. New York City passed some of the strictest short-term rental regulations in the country in 2023, effectively eliminating most Airbnb operations within city limits. Cities like Barcelona, Amsterdam, and San Francisco have all implemented significant restrictions. Entire neighborhoods that were once thriving short-term rental markets became unavailable almost overnight. If you are evaluating a short-term rental strategy, understanding your local regulatory environment is not optional. It is absolutely critical. Investors who ignored this have lost their entire business model without any warning. So how do you actually analyze which strategy wins for a specific property? You use what investors call a proper comparative analysis. Start with gross revenue potential. Get real short-term rental data from tools like AirDNA or Mashvisor for your target market. Do not use best-case scenarios. Use median occupancy rates and median nightly rates for comparable properties in that specific area. Then build out your full expense model for both strategies. For short-term rentals, include platform fees, cleaning costs, furnishing amortization, higher insurance premiums. Yes, short-term rental insurance is significantly more expensive, utility costs, and management fees if you plan to hire a property manager. Short-term rental property managers typically charge 20 to 30% of revenue compared to 8 to 10% for long-term rental managers. Once you have both net income figures, compare them side by side. If the short-term rental net income is not at least 20 to 30% higher than the long-term option, the additional complexity, time, and risk may simply not be worth it. Now let us talk about something most comparison videos gloss over: the time cost. Long-term rentals are genuinely passive once a good tenant is in place. You might spend a few hours per month handling maintenance requests and financial tracking. Short-term rentals are a hospitality business. You are communicating with guests, coordinating cleaners, managing reviews, updating listings, restocking supplies, and handling constant turnover. Even with a property manager, you are still overseeing a more complex operation. For investors who want true passive income, long-term rentals frequently win that argument regardless of the revenue comparison. On the other hand, short-term rentals offer one significant strategic advantage that goes beyond monthly income: flexibility. If you own a property as a short-term rental, you can block dates for personal use, adapt pricing to market conditions in real time, and sell the property as a furnished turnkey short-term rental business, which can command a premium price compared to a standard residential sale. That optionality has real financial value that does not show up in a monthly cash flow comparison. There is also a hybrid model that is gaining serious traction among sophisticated investors. Some landlords operate their properties as short-term rentals during peak seasons and transition to medium-term rentals, 30 to 90-day furnished rentals targeting traveling nurses, corporate relocations, or remote workers during off-peak periods. This approach stabilizes occupancy while still capturing rates well above long-term market rents. Platforms like Furnished Finder have made this medium-term model increasingly viable and accessible. It represents a smart middle path that many investors overlook entirely when framing this as a binary choice. The bottom line is this: short-term rentals can generate significantly more gross revenue, but they require more active management, carry higher operating costs, face greater regulatory risk, and are vulnerable to occupancy volatility in ways that long-term rentals simply are not. Long-term rentals offer stability, predictability, and true passivity, but they cap your income potential in high-demand markets where short-term rates are strong. The right answer depends entirely on your specific market conditions, your local regulatory environment, your personal time availability, your risk tolerance, and your broader investment goals. Neither model is universally superior. What matters is matching the right strategy to the right property in the right market with the right operator running it. Investors who understand both models deeply and choose deliberately almost always outperform those who simply chase the higher revenue headline without doing the full analysis. Do your homework. Run the real numbers. Understand your local laws. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Realty Pulse for a brand new video every single day. We will see you in the next one.